You know that sick feeling in your stomach when you check your investment portfolio and watch your hard-earned money disappear into thin air? What if I told you that two financial experts have cracked the code on avoiding those devastating losses and building real wealth through simple time-tested principles? Today we're diving deep into a book that could completely transform how you think about investing forever. I've spent years analysing thousands of investment books as a professional editor, and most of them are filled with complex jargon and get-rich-quick schemes that leave readers more confused than when they started. But every once in a while, you discover a gem that cuts through all the noise and delivers pure gold. The Little Book of Investing Do's and Don'ts by Ben Stein and Phil DeMuth is exactly that kind of treasure. These aren't your typical Wall Street gurus promising unrealistic returns. Ben Stein brings decades of experience as an economist, lawyer, and former speechwriter for Presidents Nixon and Ford, while Phil DeMuth is a seasoned investment advisor who's managed billions in client assets. Together, they've created a blueprint that challenges everything you think you know about successful investing. What makes this book absolutely fascinating is how it demolishes popular investment myths while revealing counterintuitive truths that actually work. They're not selling you complicated strategies or expensive courses. Instead, they're sharing battle-tested wisdom that has created millionaires across generations. The insights you're about to discover have the power to protect your financial future and potentially add hundreds of thousands of dollars to your retirement nest egg. In a world saturated with financial advice that ranges from questionable to downright dangerous, Ben Stein and Phil DeMuth have crafted something genuinely remarkable. The Little Book of Investing Do's and Don'ts stands as a beacon of clarity in the murky waters of investment literature. This isn't another theoretical textbook written by academics who've never risked their own money in the markets. Ben Stein brings an incredibly unique perspective to investing. Most people know him as the monotone economics teacher from Ferris Bueller's Day Off, but his real-world credentials are absolutely staggering. As a former speechwriter for Presidents Nixon and Ford, he witnessed firsthand how economic policies shape market realities. His background in law and economics, combined with decades of personal investing experience, gives him insights that pure academics simply cannot match. Phil DeMuth complements Stein's expertise perfectly as a registered investment advisor who has managed billions in client assets. He's seen every market cycle, every investor mistake, and every strategy that claims to beat the market. His practical experience provides the real-world validation for the principles they advocate. What sets this book apart from the countless other investment guides flooding the market is its refreshing honesty about what actually works versus what sounds exciting. The authors aren't trying to impress you with complex formulas or insider secrets. They're focused entirely on strategies that have been proven effective across multiple decades and market conditions. The book's structure is brilliantly simple, presenting clear do's and don'ts that cut through the confusion surrounding modern investing. Each principle is backed by solid research and real-world evidence, making it accessible to both beginners and experienced investors who've been burned by more complicated approaches. The authors have taken complex financial concepts and distilled them into actionable advice that anyone can implement immediately. The Little Book of Investing Do's and Don'ts operates on a fundamental premise that most investors are their own worst enemies. Stein and DeMuth systematically dismantle the myths and misconceptions that lead people to make costly investment mistakes while providing a roadmap for building lasting wealth through disciplined, evidence-based strategies. The book is structured around practical principles rather than theoretical frameworks. Each chapter focuses on specific actions investors should embrace or avoid, creating a comprehensive guide that readers can reference throughout their investing journey. The authors draw from behavioral finance research, historical market data, and their combined decades of experience to support every recommendation. One of the book's greatest strengths lies in its emphasis on emotional discipline and psychological awareness. Stein and DeMuth understand that successful investing is as much about managing human nature as it is about understanding markets. They provide specific techniques for overcoming the fear, greed, and overconfidence that destroy investment returns. The authors tackle controversial topics head-on, challenging popular investment strategies that sound appealing but fail in practice. They expose the marketing tactics used by financial services companies to separate investors from their money while highlighting legitimate approaches that actually work. Their analysis of mutual fund fees, market timing attempts, and stock-picking strategies is particularly eye-opening. Throughout the book, Stein and DeMuth maintain a conversational tone that makes complex concepts accessible without dumbing them down. They use real-world examples and historical case studies to illustrate their points, making the lessons memorable and actionable. The book serves as both an educational resource and a practical handbook that investors can return to repeatedly as they build and manage their portfolios over time. The book's core strength lies in 8 fundamental principles that form the foundation of successful long-term investing. These aren't flashy strategies designed to generate quick profits, but rather time-tested approaches that have created wealth for countless investors who had the discipline to implement them consistently. The first major principle revolves around the power of diversification, but not the superficial kind that most investors think they understand. Stein and DeMuth explain why owning stocks across different sectors isn't enough, and demonstrate how true diversification requires spreading investments across different asset classes, geographic regions, and time periods. They provide compelling evidence showing how investors who concentrated their holdings in seemingly safe investments like technology stocks in 2000 or real estate in 2007 suffered devastating losses that could have been avoided through proper diversification. Cost minimization represents another crucial element of their investment philosophy. The authors methodically expose how seemingly small fees compound over decades to consume massive portions of investment returns. They reveal shocking statistics about how a typical actively managed mutual fund with a 2% annual fee will cost an investor hundreds of thousands of dollars over a 30-year period compared to a low-cost index fund. Their analysis goes beyond mutual fund fees to examine trading costs, advisor fees, and tax inefficiencies that silently erode wealth. The book delivers a devastating critique of active management and market timing strategies that dominate financial media. Stein and DeMuth present overwhelming evidence that professional fund managers consistently fail to beat simple market indexes after accounting for their fees. They share specific examples of highly regarded fund managers who generated impressive returns for short periods before experiencing dramatic reversals that wiped out years of gains. The authors explain why this pattern repeats across different time periods and market conditions. Asset allocation emerges as perhaps the most critical factor determining long-term investment success. The authors provide detailed guidance on how to construct portfolios that balance growth potential with risk management based on individual circumstances and time horizons. They explain why young investors should embrace higher stock allocations despite short-term volatility, while older investors need greater bond exposure for stability. Their allocation recommendations are supported by historical backtesting and Monte Carlo simulations that demonstrate expected outcomes under various market scenarios. The psychological aspects of investing receive extensive coverage as Stein and DeMuth explore the behavioral biases that lead intelligent people to make poor investment decisions. They examine overconfidence bias, which causes investors to believe they can identify winning stocks or time market movements. The authors provide specific examples of how confirmation bias leads investors to seek information that supports their existing beliefs while ignoring contradictory evidence. They offer practical techniques for overcoming these psychological traps through systematic approaches and emotional discipline. Tax efficiency represents another major theme as the authors explain how investment taxes can consume 30 to 40% of returns for high earners. They provide comprehensive strategies for minimizing tax drag through asset location, tax loss harvesting, and retirement account optimization. Their analysis of traditional versus Roth retirement accounts includes specific scenarios showing when each approach provides maximum benefits. The book addresses common investment mistakes with surgical precision, identifying patterns that repeatedly destroy wealth across different investor demographics. They examine why investors consistently buy high and sell low, despite understanding this behavior is counterproductive. The authors provide specific examples from major market crashes, showing how emotional decisions during volatile periods have permanent consequences for long-term wealth accumulation. Finally, Stein and DeMuth tackle the investment industry itself, exposing conflicts of interest and marketing tactics designed to generate profits for financial services companies rather than clients. They explain how commission structures incentivize brokers to recommend frequent trading and expensive products regardless of client needs. The authors provide practical guidance for identifying trustworthy advisors and avoiding predatory practices that are unfortunately common in the industry. The most transformative insight from this book centers on embracing market volatility rather than fighting it. Most investors view market fluctuations as problems to be solved or avoided, but Stein and DeMuth demonstrate how volatility actually creates wealth-building opportunities for disciplined long-term investors. They explain how dollar-cost averaging allows investors to purchase more shares, during market downturns and fewer shares during peaks, automatically implementing a buy low strategy without requiring market timing skills. Historical examples show how investors who maintained consistent contributions during the 2008 financial crisis or the 2020 pandemic crash achieved superior returns compared to those who stopped investing during volatile periods. Index fund investing represents perhaps the most powerful wealth building tool available to individual investors, yet most people either don't understand it or dismiss it as boring. The authors provide compelling evidence showing how broad market index funds have outperformed the vast majority of actively managed funds over extended periods. They explain why this performance advantage isn't accidental, but rather the inevitable result of lower costs and broader diversification. Specific examples demonstrate how an investor contributing to a low-cost S&P 500 index fund over 30 years would accumulate hundreds of thousands more dollars than someone using typical actively managed funds. Starting early creates almost magical compounding effects that many young investors fail to appreciate fully. Stein and DeMuth present powerful calculations showing how someone who begins investing at age 22 and stops at age 30 will accumulate more wealth than someone who starts at 30 and invests until retirement, assuming the same monthly contribution amounts. This counterintuitive result demonstrates why even small amounts invested during early career years become exponentially more valuable than larger amounts invested later in life. Emergency fund establishment must precede serious investing efforts, according to the author's framework. They recommend maintaining 3 to 6 months of living expenses in easily accessible accounts before committing significant amounts to long-term investments. This foundation prevents investors from being forced to sell investments during market downturns to meet unexpected expenses, which often occurs at the worst possible times. The psychological benefits of having an emergency cushion also help investors maintain discipline during volatile periods. Automatic investment systems eliminate emotional decision-making that destroys long-term returns. Stein and DeMuth advocate setting up systematic transfers from checking accounts to investment accounts that occur regardless of market conditions or current events. This approach prevents investors from waiting for perfect timing or being paralyzed by uncertainty about market direction. Historical analysis shows how investors using automatic systems achieve significantly better results than those making manual investment decisions based on market sentiment. Understanding the true cost of investment fees requires looking beyond advertised expense ratios to examine total ownership costs. The authors explain how turnover ratios, bid-ask spreads, and tax inefficiencies can double or triple the actual cost of owning certain investments. They provide specific techniques for calculating total costs and comparing investment options on an apples-to-apples basis. Examples demonstrate how seemingly small differences in costs compound dramatically over extended periods. Rebalancing portfolios periodically ensures that asset allocations remain aligned with investment goals despite market movements. The authors recommend annual rebalancing for most investors, selling portions of assets that have appreciated significantly and purchasing more of assets that have underperformed. This systematic approach forces investors to sell high and buy low without requiring predictions about future market movements. Historical backtesting shows how rebalanced portfolios achieve better risk-adjusted returns than portfolios left unmanaged. Tax-advantaged retirement accounts represent the most powerful wealth-building tools available to most investors, yet many people fail to maximize their contributions. Stein and DeMuth provide detailed strategies for optimizing 401k, IRA, and Roth IRA contributions based on current income levels and expected retirement tax rates. They explain why maximizing employer matching contributions should be the highest priority for most investors, often providing immediate 50 to 100% returns on invested amounts. Investment education should focus on timeless principles rather than current market trends or popular strategies. The authors emphasize that successful investing requires understanding basic concepts like compound interest, diversification, and risk management rather than following complex trading strategies or market prediction techniques. They recommend specific books and resources that provide foundational knowledge without overwhelming beginners with unnecessary complexity. Avoiding investment fraud requires understanding common warning signs and maintaining healthy skepticism about extraordinary return promises. Stein and DeMuth provide specific examples of investment scams that have cost investors billions of dollars over the years. They explain why fraudulent schemes often target sophisticated investors who believe they have special knowledge or connections that provide access to exclusive opportunities. The authors emphasise that legitimate investments rarely promise returns significantly above market averages without proportional increases in risk. The Little Book of Investing Do's and Don'ts fundamentally challenges the conventional wisdom surrounding wealth building and investment success. What makes this book genuinely revolutionary isn't complicated strategies or insider secrets, but rather its unwavering focus on principles that actually work in the real world rather than theories that sound impressive in academic settings. Stein and DeMuth have accomplished something remarkable by taking decades of combined experience and distilling it into actionable guidance that any investor can implement immediately. Their approach isn't about achieving spectacular returns or beating the market through superior intelligence. Instead, they focus on strategies that help investors avoid devastating mistakes while capturing their fair share of long-term market growth. The book's greatest contribution lies in its honest assessment of what individual investors can and cannot control. While we cannot predict market movements or identify winning stocks with consistency, we can control our costs, maintain disciplined saving habits, and avoid emotional decisions that destroy long-term wealth. This shift in focus from trying to beat the market to participating in market growth represents a fundamental change in investment philosophy that has profound implications for long-term success. Perhaps most importantly, the authors provide hope for ordinary investors who have been led to believe that successful investing requires special knowledge or access to exclusive opportunities. Their evidence-based approach demonstrates that simple strategies consistently implemented over extended periods can create substantial wealth for anyone with the discipline to follow through. The book serves as both a practical guide and an inspiration for investors who want to take control of their financial futures without relying on others to make critical decisions about their money.